I thank you very much. I kind of apologize for getting these graphs a little bit too small. I think I should have put them in a PDF or in a PowerPoint. That would have made it a little easier. As always, if anyone has any questions, any comments, any topics, or they'd like to interject, please do so. I'm happy to answer questions in between. In fact, I prefer it. Because after all, this is something that I find very interesting, and I hope you do as well. But I also want to help anyone who has questions on almost any topic that they can think of. So let us begin. I find oil, which is the basic, and I've done webinars on oil before, but I think it is probably the most interesting and relevant of all the trading markets. Not so much for its trading facts, which of course are interesting, but because it is the intersection of fiscal policy, of monetary policy, you could say of industrial policy, of politics. It is the one commodity, because of its ubiquity, because it's everywhere and it means something to everyone. It reflects more factors in its pricing, especially in the past couple of years, past 5 years, than anything else. To begin with, oil was an industrial commodity. Its greatest impact, or the greatest impact on its price, was, of course, supply and demand. It's a relatively sleepy product, you might say. Demand rose. As long as supply could meet it, price did not rise very much. You look at this period through here. This is through the 90s here on this top chart. This is an oil. Let me just tell you what we have here. This is a price of oil going back 20 years. I wanted to keep this all 20 years because the factors that I'm talking about are relevant for 20 years. Now, this chart, I have other charts in 20 years, but these are more relevant, more recent charts. These are supply and demand figures from the Energy Intelligence Group going back to before the financial crisis. I focused on these because it's the financial crisis and its attendant policies that have changed the way oil is really trading. Not entirely. That's not the only reason, but there's another one. And this is demand. So first, let's talk about this chart right here. Oil first became a political commodity, a political football, during the 1973 war between Israel and her neighbors. The OPEC nations and their combatant allies put in place an embargo on oil, drove the price skyrocketing. The first time that oil had ever been used in such a capacity as that. That oil shock was repeated several times after that, and it brought the world to the idea that oil is a tactical as well as a strategic commodity. It's tactical because the people who possess it can deny it at certain cost to themselves, can deny it to the people who use it. That was a new event, sort of, in the political history of the world, certainly in the history of the Middle East. It's strategic because it appears, because that dominance, which once appeared eternal, is now very much in question. If you take a strategic view, then the United States possesses nearly as much energy sources as do the Middle Eastern countries, as does Russia. And that, if developed, changes the strategy involved in oil dominance. But let's go back to the price chart here. Throughout this period, there wasn't a lot going on in the Middle East. I know if you speak to people in the Middle East, and I do all the time, that, of course, is not a fair assessment of what's actually happening on the ground there. But as far as The oil business goes oil strategy, oil tactics, its effect on price. There wasn't a lot going on here. If you look at the price on this, and let's take a look at what prices we're talking about here before we go any further. Okay, we are talking about oil 93, 94, 98, 99. What price are we talking about? If you live in the United States or in Western Europe, read it and weep. $20 a barrel. $20 a barrel. Let's say that again, $20 a barrel. Okay, so that is the chart. Yeah, I'll do that on the chart. That makes it easier to see. Because we're talking about this chart right now. Okay? This is oil price chart 20 years. What happened through here? I'm not going to answer a question and ask, the old defense adage, as a defense attorney, never ask a question you don't already know the answer to. But if we are talking about a commodity that had largely been determined without extraneous political factors by supply and demand, as you would expect, what we need to do now is to go to the demand charts. Now we're talking about 2000, 2001, to that famous spike in 2008. And before we assume that it's not demand, let's look at a 20-year chart. And now remember what time we're looking at. We're looking at 2001, 2002, 2008. This is a year-to-year measure of GDP, world GDP. That's everybody. This charting platform is all from Bloomberg. I should mention that unless the mayor of where I live is listening. All of these charts are from Bloomberg. Their charting package is, in my opinion, without peer. It is the best, the most flexible, and the most widely covers more things than anybody else that I've ever seen. So it's Bloomberg. It's from a Bloomberg terminal here in our WWM offices in northern New Jersey. As a personal comment, Mr. Bloomberg deserves every penny of his billions. The system is brilliant. Anyway, remember the price chart from 2001 to that spike in 2008. Does it look like that was produced? I'm asking a rhetorical question. Does that look like that was produced by a demand spike? This is GDP. This is world GDP. From 2001 to 2008, world GDP increased, but not a tremendous amount. Let's go back to the price chart. Okay, this is the price chart here. There we have a spike of a much different order. We can look at another chart. We'll look at a 20-year. First, we'll look at 20-year demand. This is 20-year demand. Oil. 2001 to 2008. There is no doubt an increase in demand. India's industrializing. China's industrializing. First thing that a country does when it reaches middle class, everybody goes out and buys cars. What do cars do? They don't run on solar power. They run on oil. They run on petroleum products. They run on fossil fuel. So this is a chart of demand, 20 years. Now let's look at supply for 20 years. And what will you see? Not surprisingly, you see a very similar chart to the demand. So if demand is rising, and supply is also rising, then we have to seek. Now, there is a factor here, of course, that we have to talk about if I can't quantify it, and I really can't. That is, oil has become harder to extract. Some portion of this, where's the price one? Here's the price one. Some portion of this rise here, and I don't know how much, is because the oil, say in Saudi or in Kuwait or in West Texas, is becoming, there's less of it. The Saudis still have a huge supply of relatively easy, low-cost oil to extract. But the other, to ask someone on the chat, there should be sound. I think everyone else is hearing it. You might want to check to see if the speakers on your computer are turned on. There only seems to be one person who's saying that they're having problems hearing, and I apologize for that if that's the case, if it's anything on this end. So there is a factor involved in the oil which is reflected in the price, although it's harder for me to quantify. I'm not really an oil expert. And that is the oil that is increasing the demand over this period right here. In the demand chart, this is the price chart, is that oil is becoming harder and more expensive to extract. It's certainly true that shale oil and the other types of oil in the United States from fracking are more expensive to get out of the ground. So although you do see on the supply and the demand chart for 20 years a similar slope upward in the demand and in the supply, that doesn't necessarily mean that you would expect a flat price. Because after all, if the price is rising, the low-cost producers benefit even more from a rising price than the high-cost producers. So, and oil politics and oil pricing is a very sophisticated business, but it's a very political business. And so the marginal producers, the marginal low-cost producers, the Saudis basically and a few others, can have a fair amount of influence on the price. And it is in their interest to keep the price as high as possible. There's nothing nefarious about this whatsoever. And so that's part of what's going on there. So part of this price is that the low-cost oil producers are not pumping all that they can, and that the marginal cost of the newer producers is higher, and so the oil price will rise to compensate for that. Otherwise, it couldn't actually be in business. Certainly, if shale oil was too expensive, it simply wouldn't be produced. Another factor that's involved long-term is that, as with all technologies, the cost of the technology will drop with time and with research and with better production. And so the marginal cost, and of course with volume. So the marginal cost goes down. Oil and the extraction business and the refinery business are hugely capital intensive. It costs a lot to develop an oil field. I'll talk to the comments in a second. So the margin, so that also is a factor. That the cost of production, once the capital part is paid, is expended, the oil cost will go down over time because you have more and more over time volume defraying the cost of the original. Oh, please don't worry about interrupting. I like interrupting. Will defray the cost of setting up the oil fields. One reason the Saudi fields are so inexpensive is not only because it's easier to get the oil out, but it's also because much of the infrastructure necessary to extract it was set up many years ago. It now requires maintenance and expansion, perhaps, and improvement and replacement, but it's not wholesale cost of setting up a new oil field. And that's essentially what's been going on in the American West, the American Midwest, and in Canada with its Alberta tar sands. The initial cost is all up front, and of course the people who are doing that will attempt to get as much of their money back as quickly as possible. So these are natural things. So looking at this price strike right here, and I should do this quickly because some of you have probably heard this before, if not from me, then from other places. It's kind of a fascinating story. It is one purely related to markets, not to supply and demand. And it's also related to the world financial history over the past 10 years. But let's start in the beginning. We can see that right here, something changed. Something happened here. Oil usage didn't rise dramatically. World GDP did not rise. Demand did rise. And supply rose to keep pace largely with demand. That's what happened here. This is a big difference. Right here, the end of 2001, it's $20 a barrel. I even hate to think. I filled up my car this morning. I hate to think what that would mean. $20 a barrel is now 90. Say that's 4.5. So it would be about maybe $1 a gallon. I think I paid $3.60 U.S. or $3.50 U.S. $3.49 U.S. this morning. So we're talking around $1, maybe a little bit less. So from here, let's just take the middle of 2008. Okay, that's 1, 2, 3, 4, 5, 6.5 years. That's a 7-fold price increase from 20 to 140. And actually, I think it was close to 150. Well, I live in New York, and I commute out to New Jersey, so a car is a necessity. I also have 2 kids. And in this country, a car is a necessity with children. That's all there is to it. Yes, there's some change in the dollar value. That, of course, affects things as well. But this particular price spike right here, this price run, you know what it looks like more than anything else? It looks like the run-up in its longevity and in its slope, although the slope's a little steeper, especially at the end. It looks like the run-up in the yen crosses. Remember when everyone was funding in Japan? Went up year after year. And when it crashed, it drove the yen much higher, and everybody's been trying to explain it since then. But what happened here is a lot more mundane. Oil had primarily been traded on the New York Stock Exchange, on the NYMEX, the New York Mercantile Exchange. The NYMEX had limits on who could trade oil and how much they could amass as contracts. And those limits were based largely on connection to the business. That means if you wanted to put on a large oil position, pretty much the only people who could do it were people who were refiners, they were users, they were enmeshed with the product cycle of oil, from crude oil to gasoline. And the NYMEX enforced those limits. There were fewer people playing in the market simply for the type of trading profits that are the lifeblood of the foreign exchange market. We all know that in foreign exchange, upwards of 90% of the volume is not trade related. It's not somebody exchanging a trade flow from Bahrain or from Saudi Arabia or from Germany and needing the money in a different currency. That's not what most of it is. The vast majority is what we all do. It's speculative trading. That aspect of the oil market changed, no guess on this one, right around here. Right there. At that point, a number of firms, including Goldman, Merrill Lynch, and a number of others, set up with the cooperation, of course, of the British, the SFA, the British authorities, British financial authorities. They set up a new trading exchange. It's really true. I mean, didn't get much coverage out there, but this price spike has next to nothing to do with supply and demand. Let me continue. They set up another exchange in London, the Intercontinental Exchange, ICE. It was a regulated exchange. It was under the SFA, which is a very well-respected regulatory body, much as they are in America and a number of other places around the world. The U.S. and the British probably being the premier regulatory agencies of financial markets. But the rules for who could take positions in the commodities markets, in the oil market in particular, were much different. They were much less restrictive. What happened, of course, is that market, Intercontinental Exchange in London, began to dominate, take business away from NYMEX. Don't forget, during this period right here, we had, let's look at the Fed funds rates for 20 years. Uh-oh. Here? All right, we're talking about this period right here, right? From '01 to '08. From this period right here, there were low rates in the United States. There was a lot of, and it's also relatively true in Europe. This is the refi rate from the ECB. So let's go back to the oil price. Okay, so there's relative. So there was a lot of cheap credit at the time. Cheap credit means that hedge funds, speculators, people who want to make money in the financial markets have some place to go. Because after all, we're traders. We all know it doesn't really matter why a market goes up. What matters is which side of the movement we're on. So if a market becomes hot the way oil did, then not all, but many of the large international firms, the hedge funds, the banks, the prop desks, will see this and know that that's a market that they want to participate in. And since most of the restrictions on oil contracts were removed from ICE, they could go to London and speculate on oil. I have heard many commentators, both in person and on TV, or when I'm on TV, I've had this discussion with a number of oil analysts on CNBC usually about whether there was speculation involved in this. And I try to be polite, because the idea that this is anything but a speculative price to me seems absurd. A speculative spike. And so that's what happened here. This drive comes from the creation of all of these new contracts in London. Eventually, what happened was so much business was moving to the London market that the NYMEX also reduced a lot of its restrictions on participation in the oil market. So that you have now in the oil market, and a market which is much more akin to the foreign exchange market than it was before. Now, as far as percentage goes, I don't know. If I say that 90% and north of that is speculative, that means for-profit trading only, no one's expecting delivery. In the currency markets, I doubt very much that it's that high in the oil markets, but it is much higher than it used to be. Again, the people who are speculating on this price right here, by and large, were not planning on taking delivery from Cushing of 500,000 barrels of of West Texas Intermediate. But, and this is where it matters, all of the other players, the refineries, the oil sellers, the people who actually take delivery, refine the oil, and bring it to market, had to pay the same prices. Regardless of the reason they were there, both the actual participants in the market, those who take delivery, and those who are simply buying a contract to attempt to make trading profits, everybody pays the same price. That's the way markets work. So when you get this kind of price spike, it reflects and comes over, of course, into the general market in a much more direct way than, say, a speculative binge in the currencies might. Especially here in the United States, where we have a far less, the domestic economy in the United States is far less intertwined with world trade than some other countries. Okay, so that's the history of this particular price spike here. Now, that market is still operating. The point of this is that, and I'm going to show you some slides in a minute, where I'm going to use what I've said here and bring it forward into what we're seeing in the oil price here. Remember, the topic of this was an industrial commodity or a trading favorite. And this is tilting very much towards the second, as you know. So we know here that due to these changes in the structure of pricing in the oil market, who was able to participate, oil shifted much more to a trading commodity than an industrial commodity. Okay, let's look at some current information. Okay. Which one do we want to do here? Where's my QE, oil and QE? I have an oil with QE. Let's see if I've opened it yet. Bear with me. Here it is, oil and QE. Now, my thesis for this is that due to that change, and that's not the only change. There's another change we can put in. This is true for all financial markets. Let me bring that chart up once more. This one right here. Okay, this is the world 20-year price on oil. There's another coincidence, although I don't believe in coincidences involved in this chart. If I was in a classroom, teaching my 5-year-olds, I would say, who knows what it is, and someone would put their hands up. What got started right around the same time here? Of course, it's the Internet. ICE did more than one thing. Just as this business, the retail business, foreign exchange, could not and did not exist in any real sense until the Internet, because it couldn't. Same thing with the world financial markets. It is now so easy. If someone is sitting on a trading desk in, Saskatchewan, and they want to shift from one instrument to another, it is very, very easy to do. That is a new facilitation for the world's financial system. And what it means is that you end up with much more of a herd mentality than you've ever had before, especially in items like oil that are completely internationalized. Another aspect of oil that is very similar to foreign exchange. It's not nearly as true, say, with the equities, because even though there is tremendous amount of world trade and international business, nevertheless, Apple is essentially an American company. SAP is essentially a German company. So you usually have to go to, the Internet was, from the 90s, but it really didn't start moving until around 2000. Certainly the foreign exchange businesses in retail, which is the business both here and before this at FX Solutions, all of those businesses started right around 2000. Let me see if I can help you with this. Well, crude oil trading. You can trade oil on our WWM system here. You could trade it, I believe, on FX Solutions system. It's simply a commodity. You can't take delivery on it, but you trade it exactly the same way you would trade foreign exchange, the way you trade the euro or the crosses or gold. Okay, I'll answer that question about oil gold in a second. It's actually a fascinating question, but let me just finish this point here. So because of the ICE exchange, the advent of the Internet, the ability to fling money around the world at hitting a computer button, and the international commoditized business of the instrument itself, oil. Oil is the same everywhere. It's really not quite. There are different grades of oil in different places, but by and large, oil is the same everywhere. It's just like foreign exchange. If you're trading the euro yen in Asia or you're trading it in Finland, it makes no difference. If you're up and the market's open, you trade it. End of discussion. Same thing with oil. So oil is a commodity that, got a lot of questions here. I'll answer them in a minute. Oil is a commodity that is universal. So it is very, very amenable to a universal outlook, meaning anyone can trade it anywhere, anytime. The Internet and its facilitation of financial transactions means that everybody can go there. Everybody can pile in anytime they want to. Okay, so let me answer a few of these questions first. That was oil. Okay, now we're going to go to Oil and QE. But let me answer some of these questions first. Now remember where I'm going with this, or I'll tell you actually. You don't know, I haven't told you yet. Sorry about that. Oil has become, it's my thesis, far more like foreign exchange, a trading commodity more than anything else. Therefore, oil is going to be affected much more than it ever was before, not by changes in supply and demand, although it'll still be affected by that, of course. But now you have a new factor. You have the financial factor. Before this, it would have played through like this. Oil rises and falls with supply and demand. So as a financial fact, say a change in base interest rates in the United States takes place, it works itself through the oil market, through the changes in GDP, in industrial usage. It fluctuates with at a one remove as the interest rate affects the economy. But if you're talking about a financial instrument, then the effect is much more direct. If the Fed floods the oil with credit and it keeps interest rates low, then the trading portion of the world financial system has to go looking for return. Okay, I'll take that up in a minute. Let me ask you some of these questions here. Okay, how is oil related to gold? Well, the primary way oil is related to gold is this. Gold rises and falls with a number of factors, but one of them is the perceived degree. One factor I forgot to mention, let me try this, is that oil is priced in dollars. So there is a direct effect on whether the dollar is increasing or decreasing in value. If the dollar is decreasing in value, then it takes more gold, it takes more dollars to equal 1 unit of gold. And that is the interest rate. I mean, if you look at the price of gold, which is now around $15.20, I think, and compare that to the price of oil in gold, you have an entirely different chart. Because as the value of gold per dollar rose, so did the value of oil. So if you had 2 pounds of oil, 2 pounds of gold, it buys just about the same amount of oil that it did 10 years ago. Because oil and gold rise as the value of the dollar decreases. So that's the primary relationship. And this is true of other commodities as well with the price of gold, because what people do is, if people fear, I've always said there are three types of people who trade, two types of attitudes who are trading gold. People who are afraid of inflation, people who are afraid of Armageddon, and those who just view it as a trading commodity. But these things all tend to move in unison. And now, for the past number of years, since, of course, the financial crisis, as the Fed has effectively done its best to devalue the dollar, it's not the only thing that's going on. It was very, very amusing to listen to the G20 say that nobody is targeting, we should not, everyone who's a member of this club should not and is not going to target currency rates, which is one of the most, how shall I put it, disingenuous statements, meaning that you know you're lying but you're going to say it anyway, because it doesn't matter. What are they talking about? The Japanese, or at least, were straightforward enough. They come out and said, we're trying to devalue the yen because it's too strong. And by most standards, the yen is too strong. Okay, I'm not sure exactly what all that means up there, guys, so I'm going to leave it there. So what the G20 said was that that the participants there are not going to target interest rates, and that's true. But it also doesn't matter. Because if the effect of domestic financial and monetary policy is to devalue the currency, then it's irrelevant whether the central bank says that that's their goal or not, because they know very well that it will have that effect. So that statement from the G20 was more, in my mind, amusing than anything else. They do recognize, of course, that not everyone can devalue at the same time, but that's not going to make any difference. Monetary policy, financial policy, is always determined by the needs of the national unit. In the case of the EU, that would be Germany and France, and not by any international considerations. We need to keep that in mind. Whenever anyone says the Chinese are managing their currency, they are. But so is the Fed. So are the British. They're simply doing it differently. Or they're attempting to. Maybe they're not quite as effective. But the result of these policies are the same. Okay, so let me see what some of these questions are. I cannot answer the one right there. Are there Chinese, if that's a question about Chinese denominated oil instruments out there, not that trade in the financial markets. The Chinese have been making a big move to open up trade in China for settlement in the yuan, and they have done so. But as far as I know, it's not on the financial markets as of yet. When it might be, I don't know. China is buying oil supply because, as resource-rich as China is in many ways, it does not have any oil. And yes, it won't necessarily. Who owns the oil? Doesn't really matter unless they withhold it from the market. So the price, I was having this discussion a couple of days ago with a friend of mine. Actually, it was a reporter, and I can't tell you more about it because it's still a secret. But he called me and asked me whether or not the development of the American and Canadian oil reserves would be good or bad for the economy. And I said, of course it would be good for the economy because it brings jobs. I mean, from the American point of view, money that would be sent overseas to pay for oil stays at home and funds development and purchases and consumption here in the United States. So, of course, it would make for a stronger economy. And then he said, well, will the development of these resources have a large effect on the price of oil? And I said, not necessarily. Because although they bring the oil onto market, the oil is relatively expensive. Demand, just on an absolute level, is much higher than it was before. There is much less of low-cost oil around, whether that's because the Saudis are not pumping it or because it doesn't exist, doesn't really matter. See, this oil would not come on the market, the shale oil and the other oil from Canada, unless the price supported the development. So the development of these resources won't necessarily affect the price, but it will affect the economies of the countries involved. Okay. As far as government owns of the oil, not the oil that's being developed, at least in the United States. I'm not sure of Canada. In the United States, there's a tremendous. I mean, the federal government is the largest landowner in the United States. It determines whether or not there's development for oil in the lands that it owns. In general, under the Obama administration, that has been difficult or reluctant. There's not been a lot of development on government land, and that's easy to do. That's your decision. However, that's not true on private land here in the United States, and there are millions of acres of private land owned both by oil companies and individuals. That is being developed, and the vast majority of the increase in the production in the United States, it's now at, I think, about a 15-year high of domestic produced oil, is oil being produced on private land. There could be a great deal more. Now, as a legal fact, you own the oil underneath your land. The government does not. The government owns the oil underneath its land, but not underneath your land. Correct. If you see pictures of now, out in the Midwest and other places, you will see those pump jacks in private backyards pumping oil. Okay, the best website for oil price direction. That's a good question. I'm not sure I have an answer for that. I'll put at least not at the moment. I have to think about that for a bit. The Energy Intelligence Agency that I quoted before is very good. And, actually there's a great deal of information from the Energy Information Agency from, I think it's the Commerce Department in the U.S. They have extensive information there that's free to the public and very useful. The St. Louis Fed, I believe, also has a number of interactive charts relating to oil and oil price. My expectations for the price of oil. Okay, I'll answer that in a second. Oil doesn't really affect the Forex market, it's more the other way around. But let me talk about QE and oil as a financial instrument, which is where I really want to end up with this. This is a price of oil, the oil price, since 2008 and the advent of the American Federal Reserve, various quantitative easing methods or interventions in the market. I am not a believer in coincidence. Certainly not in trading markets. Certainly not in financial markets. There has been, just on this chart, a rise in the price of oil after every QE, well, not every one, but almost after 3 out of the 4 quantitative easing instances. I mean, right now, the Fed is buying $85 billion a month of MBS paper and treasuries. Just right here, from the end of 2012 to where we are in 2013, oil's gone up, about $10, almost $15, probably about $13 a barrel. What do we know about the world economy during that period? Let's take a look at demand. Where's my demand? Where's my demand chart? Sorry. Okay, this is demand. This is the end of 2013. Well, what do you know? Look at these two charts. What happened to demand? This is millions of barrels per day. Went from here to here. That is a negative slope. Okay? Look at the QE price, or look at any other price you want. So if demand is dropping from there to there at exactly the same time, well, we could use any price. Let me try a 20-year price. See if we get the correct accuracy on this one. I don't know if this goes that back far enough. It does, but I'd rather use a shorter period chart. So let's use this one. Remember, this is demand. Bleep. This is price. The two lines are going in the different directions. I'm not sure that is acceptable to the supply and demand laws of economics, unless something else is involved. To my mind, the difference is the speculative aspect that's been trading in oil for more than 10 years now, and the Fed's continuing, and not just the Fed, but other people, other central banks around the world as well, loose monetary policy. This is exactly the same period, these two charts. Demand goes down and price goes up. I'm sure it's a coincidence. So this is the difference that has overtaken, and I find it absolutely fascinating because what you're seeing is a evolution of trading markets right in front of us, right that we're participating. It's not something that you read about in a book, although we will read about it in a book. We can all write the book, but it is a change in, and this has, this is not something that doesn't really, if the oil, if the price of oil goes up, gold say, for most people that doesn't affect their daily lives. Unless you're buying gold jewelry or you need to get married. But that's not true of oil. Oil is the basic industrial commodity in the world, period. And it is very much affected now more than ever by the financial markets. We're looking at this right here, and you can track this out. You have right now I would say a complete divergence between supply and demand and price determination. Somebody is buying those oil contracts. And they're... I have to talk to those comments in a second, but I know the market controls the oil price, but many factors influence. Okay? One of them is the factor that I've been speaking about for most of this session, the change in the way oil is traded and the number of people who are participating in it. Oil has much more become a speculative commodity. But they're not the only ones who control the price of oil, or at least have influence on the price of oil. If the Saudis suddenly decided to halve their... No, Goldman does not control the price of oil. Goldman is not nearly the fearsome creature that our financial journalists make it out to be. They do not control things like this. However, OPEC has some influence. Because OPEC, they're large producers, as I was saying. If the Saudis decide to double their production, the oil price would go down. If the Saudis decided to halve their production, oil price would go down. So that's a serious effect. Now you have to ask, is that something they're likely to do? No, of course not. But it could happen. So, there is that kind of effect. Over time, the development of the vast resources in shale oil and oil tar sands in the U.S. and Canada will have an effect to bring down the price of oil, provided demand doesn't skyrocket, because over time the technology involved becomes more and more efficient and brings down the marginal cost of producing a barrel. And on top of that, you have a large degree of sunk costs that'll be amortized, so the price can come down. So there are factors that involve it. Okay. Yes, most of the oil trade the majority has moved to London. I don't have the figures on this. Let me take a look at these comments here just one second. I would agree with Carlos New York that it is true many times that over the past 10 years that one of the prime, if not the prime driver of the price of oil has been the market. And I mean the market in the sense that people are looking for trading profits. Now look, if we are trading currencies, we incorporate into our view, into our positions, and into our decisions many factors, both technical from the market and fundamental from the world economy, from interest rates, from all of the things that we think about and talk about. They all go into our decision. Exactly the same thing happens in the oil market now. I would make a parallel, and the type of trading that goes on is very similar to foreign exchange now. The difference is that this is a recent change in the oil market, whereas the currency markets have essentially always been this way from the very beginning. Now, as I said, oil is on the front line of financial changes. Whereas before, I would say that financial changes were a secondary factor. Now, if the Fed starts QE and starts flooding the world with as much as it can with dollars or with currency, with liquidity, some of that liquidity will make its way into players in the oil market and other markets who will use it to seek trading profits. The Dow is another great example of this. And, I'm not simply saying, well, this is what I think is true. This was specifically Ben Bernanke's idea. That the wealth effect from the Dow. Yes, 2 days ago, or at the end of last week, I think it was, the Dow, and I'm only using the Dow as an example, the Dow was 100 points from its all-time high. Does that make any sense? If you take the Dow as a reflection of the health of the United States, corporate profit, even corporate profits, which although they're good percentage-wise, they're relatively mediocre or weak as far as actual absolute amounts. So does it make any sense that the economy contracted 0.1% in the fourth quarter? And even if that's revised up, even if it's running at 0.5%. So you have an economy in the fourth quarter that's running 0.5%. The economy for all of 2012, I think, was about 1.8% or less. It's looking like it's going to be weak again. Yet you have the Dow within 100 points, less than 1% of its all-time high. Does this make a great deal of sense from an economic point of view? It does not. But it's the same point that's here. It's the same point that's in the oil markets. I will have to finish in 1 minute. So let me see if I can. If there are any more questions here, please type them in now, and I'll be glad to answer them. That's the Bilderberg group, not the Bilderberg group. I don't think they actually control anything. They just talk a lot. Anyway, the change in the past 10, 12 years, for the reasons that I spoke of, are affecting the trading markets in a very specific way. All of the trading markets now, not all of them, but many of them, especially the ones that have popular internationalized products like oil, like currencies, have become much more subject to financial changes than they were before. This chart of oil, I think, is one of the, and its relation to QE in time, I think is one of the best indicators of the changes that we've seen. And what does this do? Well, of course, it gives the central banks much more power. How they choose to utilize it is a different question. I think the central banks remain and will remain primarily subject to the needs of their national economies. And that is the history of the chart we have in front of us. Okay, I think I should stop here. I did cover most of what I wanted to cover today, which, as some of you know, is not always the case. I will put my email up there so you can contact me on any of these questions. I'll also put my office phone number if you're so inclined to talk. I'll be happy to answer any questions that anyone has. This is my office number here in New Jersey. Again, I thank you all for attending. I hope that you found this interesting and stimulating and something to go home, perhaps take to your trading with you. And I'd like to thank FX Street and Maud and Vicky for presenting this webinar for all of you. Again, thank you very much, folks, and have a great day wherever you are on our lovely blue planet. Take care. Let me put in my email again. My email is jtrevisani@worldwidemarkets.com. Thank you very much, and everyone have a good day.